If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. The U.S. economy just hit a wall in 2025. GDP growth slashed to just 1.2% in the first half. Interest rates stuck at a crushing 4.5%, inflation creeping back up to 2.7%, and debt spiraling toward 128% of GDP. Consumer spending is freezing up as families face higher borrowing costs. Housing markets are stalling under mortgage rate pressure. Businesses are delaying investments and hiring plans. Labor markets show early signs of cooling despite low unemployment. The question every investor is asking, how bad will this get? The U.S. economy in 2024 to 2025 exhibits clear signs of a slowdown, manifesting through subdued GDP growth, still elevated interest rates, moderate but persistent inflation, low unemployment, and a rising debt burden pointing to an economy in transition. From rapid recovery growth to extreme caution, the GDP annual growth rate decelerated in recent periods. Real GDP growth averaged roughly 2.8% in 2024, a slight dip from 2.9% in 2023. In Q2 of 2025, growth slowed to about 3.0%, following a contraction of 0.5% in Q1. Early signs from the first half of 2025 indicate growth near 1.2%, signaling a loss of momentum relative to the prior year's pace. Despite slowing growth, the unemployment rate remains low and stable. In June 2025, the rate sat at 4.1%, rising modestly to 4.2% in July. Long-term unemployment remains moderate at around 1%, showing that layoffs remain modest even as growth slows. Interest rates remain elevated. The Federal Reserve's benchmark rate is currently at 4.5%, unchanged through mid-2025. This level, though slightly eased from peak levels earlier in the year, continues to burden borrowing for households, businesses, and housing. Inflation has moderated from its highs but remains above the Fed's target. Headline CPI inflation rose to 2.7% in June 2025, up from 2.4% in May. Core inflation remains sturdy with upward trends in service prices, and housing costs driving inflation expectations. Overall CPI for April 2025 measured around 2.3%. The debt-to-GDP ratio continues its upward trajectory. At the end of 2024, government debt reached roughly 124% of GDP, a historic high. Recent estimates project the ratio may edge toward 126 to 128% in 2025, underscoring fiscal pressures stemming from lingering pandemic-era spending and shifting revenue streams. Key macroeconomic indicators at a glance reveal the full picture. GDP growth approximately 2.8% in 2024, Q2 2025 at 3.0%, first half of 2025 near 1.2%. Unemployment approximately 4.1% in June 2025, modestly up to 4.2% in July. Interest rate held at a restrictive 4.5%. Inflation 2.3 to 2.7% with core inflation elevated. Debt to GDP elevated at 124%, trending toward 126 to 128%. This constellation highlights a slowing economy facing residual inflation and tight financial conditions, even as labor markets remain resilient. Sectoral dynamics contributing to the slowdown include consumer spending remaining cautious. Historic strength in consumption is easing as elevated financing costs constrain household budgets, and slower wage growth impacts family spending power. Residential investment is under pressure as mortgage rates remain high due to elevated policy rates, dampening new home purchases and construction activity. Business investment is cooling as firms face increased borrowing costs and demand uncertainty, leading many to delay capital expenditures and hiring. Trade balance dynamics provide modest support with recent import shrinkage. While exports stabilize, net growth contributions from trade remain minimal. Labor markets stay tight but vulnerable. Although unemployment is low, job creation is slowing and wage growth may lose pace, particularly in service and manufacturing sectors. Inflation dynamics show persistence in services and rents. Headline CPI may appear moderate but core components suggest continued underlying price pressures, complicating the Fed's path forward. The fiscal situation tightens as rising debt ratios limit room for fiscal stimulus or tax reform, especially amid growing entitlement and interest obligations. Multiple risks threaten this already fragile outlook. Risks to the outlook include geopolitical tensions or energy shocks which could reignite inflation, or weigh on consumer sentiment and spending patterns. Global growth weakening may suppress export demand and business confidence. Wage price spirals in services or housing could delay inflation deceleration significantly. Diminished fiscal flexibility limits response to future recessions or crises. Policy considerations to address slow growth and high rates require adopting gradual, data-driven monetary easing. If inflation trends lower while avoiding premature reversal. Provide targeted fiscal relief, especially for sectors hit by rate stress or demographic shifts. While maintaining debt sustainability, support housing with smart incentives for construction and affordability without reigniting price surges. Invest in productivity-enhancing infrastructure, digital, green, and logistical to spur long-term growth. Encourage small business financing via credit supports or adaptive regulation to counter high-rate barriers facing entrepreneurs and small enterprises. Monitor service sector cost dynamics and consider micro-targeted interventions to stabilize rent and wage inflation in critical sectors. If measures are well calibrated, a gradual recovery could restore growth toward 2.5 to 3%, stabilize unemployment near 4%, allow inflation near 2%, and slow debt accumulation significantly. Failure to adjust policy could prolong stagnation at rates below potential, risking erosion in living standards and macroeconomic resilience. In summation, the U.S. economy in 2024 to 2025 is entering a period of slower expansion amid persistently elevated interest rates. Growth has slowed from its prior pace, inflation remains sticky above target, borrowing costs stay high, and fiscal pressures intensify across multiple sectors. While labor markets remain relatively strong, signs of strain are emerging. Navigating this landscape requires cautious, coordinated policy steps to foster rebalance, without triggering renewed inflation or recession. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.